My name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar. The last 2 weeks, prices have been caught in not only intraday indecisive moves, but also interday indecisive moves, with one series of actions going to a third countering level, a sure sign of intraday indecision. Indeed, this all started back in mid-April with the end of the run-up from the March to April V-bottom, as the market reached the 21st century 50% absolute Fibonacci line at 1809 and got stuck trying higher and stuck trying lower due to the overload of support below. Now, I'm not only just talking about the support congestion from the recent 50% Fibonacci line at 1681 down to the 50% Fibonacci on the big October 2016 to April 2020 move at 1649, nor even to the extension of the congestion a little lower down to 1633. No, I'm talking about all the things inside there. The rising short medium moving average, currently 1676, and the rising medium moving average, currently 1658, which both made a golden cross 2 weeks ago, plus the lower time, currently 1684, of the December 2020 to April 2021 bullish Andrews pitchfork. All these below are supporting now against the single 50% absolute Fibonacci line overhead. Now, don't get me wrong, on the surface we have what looks like strong support that can withstand some testing. However, that barging between levels since late April has either left us with a possible bullish halfway hesitation or halfway measured move higher since the V-bottom, or else, since April, we have a possible triple top type action. Neither solutions are clean or clear. Indeed, I feel as if I'm repeating myself from a month ago. However, until we have a clear indication, the range on the wide is going to be between the supports 1630 and 1681 up to the 50% 21st century absolute Fibonacci line at 1809. Ice Europe white sugar. Yet again, compared to the New York contract, this one in London continues to be different. Primarily here now, the February to May bearish Andrews pitchfork, giving what looks to be the current bearish angle of attack from the upper time, currently 462.70, and the original battered April to July 2020 bullish shift pitchfork. Okay, so this latter bullish pitchfork has worked and may still continue to work after a fashion. You see, it was broken back in late March into April, but it has seemingly repaired itself enough to function and still seem important during the late April period in May, when the middle time, currently at 490.70, capped the rises, though obviously not on a first attempt in either case. However, this newer bearish Andrews pitchfork had initially stymied the weekly key reversal up from 2 weeks ago, and then pushed prices lower, below the flatlining medium moving average, currently 456.10, and a similarly equipped short medium moving average, 451.80 currently, as well as the recent 50% Fibonacci line at 452.30, such that last Friday we saw a new breach, though no close lower, under the lower time, currently at 451.30, of the original April to July 2020 bullish shift pitchfork. This was added to today with an open and high below the lower time, the first since early April. Now, we have some support on a closing basis at the recent 38.2% Fibonacci line at 443.30, but really nothing underneath that until we start looking until the April congestion between 429 even and 420.5, which now sits the rising long moving average, currently at 426.5, something that wasn't there back in April. So, depends if the market will cling to the broken lower time, like washing to a clothesline, because otherwise there doesn't seem that much support below until the 420s. One final point to think about. The April and May high originally set up the opportunity for a double top. This has now in June become a possible head and shoulders top with a neckline approximately where the 38.2% Fibonacci line at 443.30 is situated. Now that's something to ponder, that one. White premium spread. After a series of indecisive spinning tops from early May until just before the end of that month, it finally took a decisive, if not notable, bearish engulfing pattern 3 weeks ago to resume the fall that had been there since late April. Last week the market dropped down and closed below the neckline of the failed 2020 based head and shoulders top, currently at 75 even, finally taking the market out of the congestion between the neckline and the big old 50% Fibonacci on the July 2019 to May 2020 move at 80 1/4. Prices even dropped down and closed below the relatively recent shallow uptrend, currently at 70 even, and into the congestion from late 2019 between 56 3/4 and 66 1/2. That is where we are this week. A small reactionary move back up, but not enough to test the broken uptrend as yet. Overall, the big May 2020 to February 2021 bearish Andrews pitchfork is now running this market. Lower it seems. The market is in between the upper time, currently at 90 1/2, and the middle time, currently at 55 3/4. And until we see the market move out of these strictures, then this bearish pitchfork will prevail. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.